Hi, I'm Tracy Sofra and welcome to the Women of Wealth podcast, dedicated to helping women achieve financial independence in every area of her life. Today I'm going to talk about not panicking, ignoring the noise and knowing what to do past that. What am I talking about? Well, I know there's a lot of noise right now about stock market drops. We've experienced a 15% drop lately. Talks of global trade wars and tariffs and maybe even another economic downturn. And it's hard. I know. I understand. It's hard not to feel the panic creeping in, okay? But I want you to take a deep breath with me. All right? This is not the time to let fear take the wheel. This is what I call the backdrop. And the backdrop will always exist when you're in the investing game. When you've got money invested, and let's face it, all of us do, because every single person has a superannuation fund in Australia. So your super fund is invested in shares in the share market, be it American share market, the S&P 500, the ASX 200, which is the Australian share market, a little bit in properties, a bit of fixed interest, a bit of cash. We're all invested. All right. So whether you're invested through your super fund, whether you're invested in your own name, in the way of direct shares or maybe some managed funds, we are all invested and we are all affected by what I call the backdrop. There's always going to be political, social, economic turmoil, changes, rhetoric, talk that will change the way markets respond, because markets, generally speaking, responding to or led by, let me just say this, driven by confidence, I guess, more so. And that confidence dips when uncertainty appears based on what's happening in the world, in the global economy. We are a global, we're connected globally more than ever, as we all know and abundantly aware of. So there's no way that your investments are not going to respond to any of those. But remembering this, the first thing to do is not panic, as I always say to my clients in my private practice. And the second thing to do is just stop and ask yourself key critical questions. So what would be the first question that you would ask? Has my long-term goals changed? And if the answer is no, okay, so I stay the course. Have any of the underlying investments that I'm invested in, have they gone sour? Have they gone backwards? Has something happened to them that is going to cause further downturn in my investments or not going to give me the long-term growth I'm looking for? If the answer to that is no, and you are simply responding or feeling uncomfortable about what is going on at the moment from an emotional point of view, then you must stay the course. Staying the course means any investing is always about the long term. It never is about, right in front of your face, the here and the now. It's always about the long term. So you've got to keep your eye on the prize, the long-term prize, and do not, under any circumstances, get spooked, get panicked. It's easy to do, and sometimes it's easier to do depending on your environment and the people you're hanging with and the information that you're fed all of the time. So I would say to you, I would suggest that your source of information is of credibility, making sure that you're not just listening to every person on social media. What is their knowledge? What is their background? What is their purpose? Is another thing you might want to ask. If they're trying to spruik something else, they're definitely going to be bagging out what you're invested in to get you across to the other side. So you really got to have your wits about you, making sure that, who do you listen to? Who do you trust? What is their credibility? What have they done? And what are their intentions around all of that when we're in the midst of all of this, and the company you keep can either spiral you out of control or keep you grounded. So stop, reflect and think. If the long-term goal has not changed, if the underlying investments are still solid, stable and, AAA rated, then there is no need to change. You must stay the course. That's pretty much it in a nutshell, is where I would start with, and definitely position yourself in that particular situation. So it is a time to pause, to regroup if you like, and move with intention, all right? Don't get panic driven and start doing silly things like selling down and going back to cash. And I often hear, I have heard over the years where certain clients have even said, oh, I pulled all my super back to cash. And I just cringe and think, oh my goodness, why didn't you call me? Why didn't we have this conversation? Why would you sell out? So if the market drops, and as a result of, tariff wars and talks of recession and changes of government and all of these things that are happening at the moment, if that is causing you grief and you are considering selling down, remember this, the minute you sell down, so if you are fully invested, you sell those down and you go across to full cash, you have taken that loss. So if your portfolio is down by 10, 15%, you will never make that up again because you have taken that loss, you have sold on a low and you've gone into cash. No one can time the market. If I could time the market, I've said this 1,000 times, you've probably heard it before, I would be in the Bahamas sipping a pina colada or maybe a mocktail of some sort. No one can time the market. It is time in the market. It is about following tried and true methods of asking those key questions, of making sure that you are drip feeding the system when the markets are down. It's a massive opportunity to buy more. So sticking to the tried and true methods that I talk about all of the time through my podcast, through my private practice, and obviously through all the programs that we offer in the WOW community. So here's what I want you to keep in mind. Okay, so if you have income coming in at the moment, I want you to focus on, and this is based on the situation that we find ourselves in, but nothing is forever. Remember that too, yeah? We're all old enough to know this. We're all old enough and wise enough and have enough life experience to know that the current situation will not last forever. Things change all the time. But I want you to focus on managing your cash that you might have and prioritise saving and stockpile a bit if you can for emergencies and peace of mind. And honestly, I just want you to live your life without having to dip into your investments. Do not, under any circumstances, dip into your investments when the share market is rocky, as I've always said and have just repeated myself in this podcast as well. And speaking of investing, if you are in a good place, which with investing, I always suggest that you invest on a continual basis. So if you've gone into, outside of your super, there are what we call non-super investments. What are they? Well, typically speaking, they're either a direct share portfolio, a direct property, direct meaning in your name, you have gone, you have purchased it, and you're managing that asset, versus going into REITs, which are real estate investment trusts. Somebody else makes the choices and manages it for you. You simply become a unit holder, and you let that investment manager who has the REIT, who owns the REIT. It could be a Vanguard. It could be any number of investment managers. And they're making all those decisions for you. You should drip feed that system. What does that mean? Like a savings plan, whether it's $100 a month, you should continuously add to those investments, just like your super is added to via the 11.5% from your employer, or any salary sacrifice you might be doing, or any after-tax contributions you might be doing. You're adding to that on an ongoing basis. That is powerful. That is what we call dollar cost averaging, and that is what we call having the power of compound work in your favour. Not only does your money make money, but the money that your money has made is making money, if that makes sense. That is extraordinarily powerful. And now is the best time. Look, we've regained a fair bit of that 15% downturn. That was a moment in time, and there are always moments in time. But when you see a share market dip and you are in quality, never, ever do speculative. I am quite conservative in my approach. If you want to do speco stuff, maybe tuck away a 5-10 grand separately and do it somewhere else, but stay the course with your main investments, with your main strategy, with your main super and any other investments you've got in your own name. And if you want to do speco stuff, tuck it aside, like separate it if you can, even like a completely separate investment strategy on the side if you wish to do so. I don't like taking unnecessary risks that I don't need to take, particularly at my age where in terms of the runway that I have, my runway, based on how I feel at the moment might be 5, might be 7, might be 10 years. And so for me, it's about following tried and true methods and returns that have stood the test of time over the last 100 to 134 years. So make sure you're investing if you can. And, as I've always said, the sale is on. The market has dropped 15%. If you've ever wanted to buy a Commonwealth Bank share or a CSL or something, a BHP or a Rio, if you've got a direct share portfolio, if you've ever wanted to do that and top that up even further, you just got a 15% discount. Get in there and get some more, right? I mean, what do we do, girls, when the sale's on with shoes? Dare I mention shoes? One of the loves of my life. I manage it well now. There was a time in my life where I didn't manage that too well, but I managed that well. What do? We go and buy a pair. So buy some shares. It's exciting if that's what you've already got set up, if that's part of your, long-term investment strategy. And you will be happy to know that inside your superannuation fund, that is exactly what is happening, because as your employer puts in the 11.5%, going to 12, by the way, 1st of July 2025, by them putting those funds in there, you are buying more and more. And when the market dips, you're getting more bang for buck. All right? And history has shown us time and time again that markets dip and they also recover. If you look at a trend, you can simply Google the returns of the Australian share market over the last 100 years. You will see a graph that's kind of squiggly like this, right? What I'm doing with my finger is I'm squiggling it for those of you who are listening and not watching. Squiggling along like this tiny little thing that's going up and down, up and down. But what you will notice when you look at that graph, I want you to look at the trend of the graph. What is the trend? Is it downturning or is it going up? And the trend of that graph will be going up, okay? And that's what I'm talking about. And all those little squiggly lines along the way are all the things and the stuff that has happened throughout history over the years, between world wars and depressions and GFCs and what was that, Black Friday in 87 or whatever it was. I was a bit young for that. We've lived through pandemics, we've lived through wars, and there's a lot more that's coming our way. We can assure ourselves of that. This is the world we live in. This is remember I mentioned the backdrop. It is the backdrop. It is the nature of the beast. And you really got to get your head around that. You've got to be okay with that in order to progress, right? So investing is a long-term game. That's the game you're in. So temporary downturns doesn't erase the long-term potential. Just remember that. Temporary downturns are those little squiggly bits in the trend, that long trend of going up, that line that is going up, not going down, is the trend we're looking for. The squiggly lines is the bits that go up and down as markets respond to whatever's happening in the economy. I probably shared this with you before, but the Australian share market over the last 134 years has averaged a 13% return. That's got to make you feel good, right? Over 134 years, what have we lived through? We've lived through world wars and depressions, global financial crisis, pandemics, the Ukraine war, and now what's going on with Trump in the US. We're living through a bunch of stuff, and it's basically returned a 13% return. If you look at the S&P 500, which is in the US, over the last 100 years, their average return has been 10.13. So what are you worried about? I guess it never feels good. I understand it doesn't feel good, but like every other area of your life, managing the emotional side of things is probably the hardest. And like every other area of your life, as I've just said, you've got to manage the emotional side of investing because, money is a very emotionally charged topic and it's not easy to earn. It's tough to earn. It's hard to watch it go down. But having faith based on the stats that I just shared with you, 134 years, 13%, 100 years, 10.13%, looking at trends of graphs, looking at the historical returns, looking at what's happened in the past. I know the past cannot determine or qualify what's coming ahead, but it's all we've got to go on, isn't it? And so what do? We base our future decisions based on past performances and what has happened in the past. And so based on that, I would suggest it's going to be okay. And please, please remember this, that retirement is not one day, right? The average retirement lasts about 20 years if you're retiring at the age of 65. That's an average. So if you're not retiring today or even this year, there's no reason for you to cash everything. Absolutely under no circumstances should you cash everything. So let's stop, panic-driven media, because the media love to sell stories. Remember I spoke earlier about the company you keep and what you're watching and the credibility of that and what the intention behind that is. You've got to really have all of your antennas up socially, online stuff, depending on what your environment looks like. So panic-driven media headlines convincing us that short-term decisions or convincing us to make these short-term decisions with long-term money. This is long-term money. This is, depending on how old you are, 5, 10, 15 years away. So just, pause, reflect, regroup, move with intention. Don't do what the masses are doing. Do the actual opposite. Warren Buffett has said that a multitude of times over the years. Do the opposite of what everybody else is doing. Most people panic and sell out. It is time to buy. But remembering this, it is time to buy. I'm going to qualify that because a lot of people go and buy speculative stuff or advice from their family members or friends or Bob down the pub who have said, this is a fantastic stock. I have heard that over the last 35 years over and over and over again, and not one time of when I've heard that has there been a success story. Absolutely not. We even did it really early in the piece, my husband and I, on the advice of a very credible source, and it didn't work out. So I'm telling you from personal experience, follow the tried and true methods. We have the ASX 200. It's the Australian Stock Exchange. It is the shares that have been around forever. Over the last 134 years, a 13% average return. Why do I want to reinvent the wheel? Why do I not just follow what has been solidified and what gives me comfort? That gives me comfort when I think about that. So I would argue that investing in the Australian share market and investing in quality stocks, what am I talking about? Well, I'm talking about the 4 banks. I'm talking about the BHPs, the Rios, the Cochlears, the Transurbans. What else is off the top of my head? Wesfarmers, we're talking about JB Hi-Fi. Well, there's an array of them if I've missed any of them. CSL, huge share. CBA is one of the 4 big banks. All of those types of stocks, that's what I'm talking about. Tried and true, that'll stand the test of time, that irrespective of the backdrop that I've just spoken about, will continue to rise. Again, I'm going to share the CBA story with you again, depending on which podcast you've listened to and which you haven't listened to. What I want to share with you is it's been one of my favourite stocks for a very, very long time. Prior to the GFC, the global financial crisis, if you cast your minds back to 2008, it was about a $65 share. Don't quote me on it exactly, roughly $65 share. In the middle of the GFC, it dropped to about $30, $32. It then regained prior to the pandemic. Was the next biggest thing that sort of happened. But prior to it, regained from 32 back to its original 65 and more, got to about 95. The pandemic was declared on the 20th of March 2020 and it dropped to around the $50 mark. And now it's sitting at anywhere between 150 to 160. That's what I'm talking about. So if you panicked when you had it before the GFC and you sold it for half price from 65 to about 32, you would not have got it to the 165 that it's sitting at right now. So 2008, $65 shares, now roughly $165 share. Had you have cashed out at either the GFC at $32 or the pandemic at $50 odd, you would not be sitting here $100 up per share. So just for one, think about that. That's what I'm talking about. So, yeah, ignore the backdrop. Understand that the backdrop exists all of the time. Understand the tried and true methods. Regroup with the people that you're hanging with. Make sure that you're listening to credible sources. Don't get involved in the hype and the panic of, oh my God, the world's coming to an end, Chicken Little, the sky is falling. Be mindful of your long-term goals, what you want to achieve, and obviously, behind all of this lies a solid, stable portfolio that is, part of the S&P 500 or part of the ASX 200, credible sources, credible investments that have stood the test of time. I'm certainly not speaking about crypto or Bitcoin or anything that I don't really understand or any other speco type shares. Again, if you want to play around with those sorts of things, I would probably do it as a side thing, pop away the 5 or 10 grand or whatever. I certainly would not invest my whole portfolio in anything like that. Sometimes there are companies that have just come up and they might be in the mining industry and that you might be able to get it, 5 cents per share, and you might think it's going to double to 10, which would be fantastic. And if you want to play around with things like that, don't do it with the whole portfolio. Set aside an amount that you can afford to play around with, and it's not going to impact your long-term goals and your long-term investments. And you can do that on the side if you so wish. But again, it's horses for courses, and depending on your current position, how long you've got to go, what is your runway, what are your goals at the end, and how you're going to achieve them. So that is really the summation of, I just wanted to talk about where we're at the moment, how it's making you feel. If you're feeling nervous, I hope I've given you some comfort in understanding how to tackle it, how to go about it, and setting some boundaries around yourself and giving you some comfort with some of the statistics that I've shared and the strategies that I've just shared with you. But having said that, every little bit that you save and every little strategy that you put in place and make smart decisions, they all matter at the end of the day. Every little action on a combined effect has a major impact to the end result. And I know that everyone is doing the best that they can with what they have. But you do need someone like me in the corner reminding you of where you're at, where you want to go, stepping back from the rhetoric, recalibrating yourself and understanding that it's going to be okay provided I've got all of these things in place and I am not going off the beaten track and trying to reinvent the wheel and listening to every, Tom, Dick and Harry about different investment types that are going to make me money overnight. My belief and my thoughts on that. Tried and true methods, little steps at a time that accumulate to massive impact at the end. And money isn't created overnight. It is created by making confident financial decisions with good research and good knowledge around understanding what works and what doesn't work, and staying the course. And staying the course is probably the hardest thing to do nothing. But, as I said, you don't have to do nothing if you've got an extra bit of cash. Even $5 extra a week, even $10 extra a week will have an impact on the end result. So do what you can would be what I would say to you. If this message has encouraged you and, it's sort of moved you to a place where you're feeling a lot more comfortable and you're thinking, gosh, I would really love, my girlfriend to hear this, feel free to share it with someone that you think and that might really benefit from that as well. And if you want us to support you in your forward planning and you would like some more comfort, then make sure to book a call with one of our strategists. We would love to support you on your money journey. You simply have to go to wowwomen.com.au and click our programs to have a chat with one of our financial strategists. And the best thing is it is free, simply free and no obligation. If you found today's episode helpful, please share it with a friend, leave a review if you wish, and don't forget to subscribe so you never miss an episode. And until next time, take control of your wealth and your future.